Hello, dear algorithms traders. Today's post is about the question of how important the spread is in trading. Of course, you can save money by using a cheaper spread, but there are much more important aspects that very few traders have thought about. And that is exactly why today's post is so exciting. Every trader goes through three crucial phases in trading. First, the break-even point must be reached, then the trader must make a profit in order to earn a living in the long term. At the beginning, the losses are greater than the profits, but reaching the break-even point changes this situation immediately. The step from loss to break-even point is the hardest hurdle for a trader and accounts for around 60% of the entire effort. Once the break-even point has been reached, it is only half as difficult to make a profit. If you are then sustainably in profit, you will easily manage to earn a living in the long term. No matter where you are right now, there are still many hurdles ahead of you in the next few months and years that you will have to overcome. Out of 100 people who start trading, just 10% reach the break-even point and only 2.5% can make a living from trading in the long term. Now you automatically have to ask yourself why this is the case, and the answer is obvious: because most people have no clear concept, and this is especially true for the many incompetent trading coaches who promise their students the moon. Let's imagine that we are trading with a gross RRROF1. This means that our TP is just as far away as the stop. However, many people forget to factor in the spread. If we win, we get $15, and if we lose $45. With a win rate of 50%, this corresponds to an average loss of $30. We now reduce our spread, which automatically reduces our total loss, although with a win rate of 50% we are still in the loss. Funnily enough, the trading coach now recommends that we simply increase our risk-reward ratio from 1 to 3. It should be noted that the trading coach has no idea about the theoretical probability of winning. How could he? After all, he has never been profitable. In this example, your theoretical probability of winning is 40%, in 60% of cases you lose. And that is because the price would have to run 45 ticks to make a profit, but only 30 ticks to make a loss. With RRROF3, the price would have to run 105 ticks to make a profit, but is already in loss after 30 ticks. That means your probability of losing is now 78% and your theoretical probability of winning is almost halved. Don't let the trading coaches fool you. In most cases they have no idea about trading. But let's delve deeper into the subject. You will be amazed at what we find. Our entry is at 1.10120 and the TP is at 1.10150, which is a total of 3 pips. We set the stop at 1.10100, 2 pips from the entry, which corresponds to a gross RRROF 1.5. The spread is 1.5 pips, which is 15 cents for 0.01 lot. The break-even is therefore reached at 1.10135. We enter at price level 1.10120 with a market buy order, and this now runs into a limit sell order on the best ask side. We are now in the market and start at 15 cents. As soon as the price reaches our break-even, we are at 0. At price level 1.10150 we would have a total profit of 15 cents. The stop is 20 ticks away and would cause a loss of 35 cents because the spread has TOB taken into account. This means that the net RR is 0.43. The TP and entry as well as the stop remain at the same price level, but now the spread is reduced to 1 pip. This means that break-even has already been reached 5 ticks earlier. This increases the profit to 20 cents, and although the stop is just as far away as in the first case, the loss is reduced to 30 cents and the net RR increases to 0.67. We reduce the spread to 0.5 pip, the break-even moves closer to our entry, and the net RR increases to 1. The theoretical probability of winning is 40% in all 3 cases, with the break-even being reached ever faster, the profits increasing and the losses decreasing. Of course, it is also possible to increase the stop at no extra cost using AK per spread. In all 3 cases we set the TP to 15 cents, and although the first stop is 20 cents, the second stop 25 cents, and the third stop 30 cents, in this case the profits and losses are all the same. With an ATR of 1.2 we reach the TP in 150 seconds, with a spread of 1 pip it takes 125 seconds, and with 0.5 pip only 100 seconds. That is 33% less time. At the same time, the time until the stop is reached also increases. In principle, we simply swap the TP and the stop. The win rate increases by 10% and the loss rate is reduced by 10%. Let's look at the relationship between break-even and stop. In the first case, the probability of reaching break-even before the stop is 57%, in the second case it is already 71%, and in the third case the probability is 88%. The likelihood of reaching the stop before break-even has been reduced by 3 times. Reaching break-even is reduced from 75 to 25 seconds, and with a spread of 0.5 pip the stop is only reached 50 seconds later. These are already huge differences. Let's assume that a trader reaches his break-even point after 10,000 trades. The longer the time unit in which he trades, the longer it takes to reach the break-even point and the higher the losses automatically are. Now let's look at how the spread behaves on the way to the break-even point. With a spread of 0.5 pip, 500 trades of 0.01 lot are completed per month. The initial win rate of 30% causes a loss of $37, and the real win rate is 30%. The next month the win rate increases by 1%, reducing the loss. After 21 months and 10,500 trades, the break-even point is reached. The total loss is $387, although the broker actually earned $525. With a spread of 1 pip, the break-even point is reached after 31 months, after 15,500 trades, and a win rate of 60%. The loss is $857, and the broker has earned $1,550. A spread of 1.5 pip ensures that the break-even point is reached after 41 months, with 20,500 trades and a win rate of 70%. The loss is $1,510, and the broker has earned $3,075. The break-even point can therefore theoretically be reached in half the time and with 4 times less loss. After the break-even point has been achieved, it is now time to make a profit. We now need 16 months for this, with the number of lots gradually increasing. The win rate increases optimally from 50 to 65%, bringing a total net profit of $2,600. The broker earns $7,200 in the same time, which is almost 3 times as much. With a higher spread, the win rate naturally decreases. The trader has now completed his profit phase, is now trading with 1 lot and a gross RRROF2. The win rate will increase from 65 to 76% over the next few years. In total, he would then have completed 20,000 trades. With a spread of 0.5, his net earnings are $76,500, with a spread of 1.0, $54,000, and with a spread of 1.5, $32,000. That is 60% less profit. In the first case, the broker earns 40% of the net profits, in the second case, 110%, and in the third case, almost 3 times as much. After 5,000 trades with RRROF 1.5, the expensive spread trader makes a loss of $20,000, the medium spread trader is at break-even, and the cheap spread trader makes a profit of over $20,000. The cheaper the spread, the more the risk per trade is reduced. Although the same trades are made, the real profit rate is up to 20% higher. This also reduces the current trader tax, which allows a maximum deduction of €20,000. This means that the trader with the lower spread automatically has a higher net hourly wage. 80% of all trading coaches recommend that beginners trade in the S&P. We all know that high volatility automatically causes a high spread. High volatility means high risk and therefore automatically high costs. Since the S&P is twice as volatile as the Eurist, a beginner's money is lost twice as quickly. So don't get ripped off and instead look for a market with normal volatility. With the pip value I developed per minute, you can see the risk in the market. Information about this can be found in my numerous videos. In recent years, more big players have switched to the Eurist, which has led to an increase in liquidity and at the same time a reduction in the ATR. This means that you can currently reach your break-even point with less loss. Here we see 2 traders who entered the market at the same time with 0.01 lot with different brokers. The difference is almost 50% and the pip value per minute is also 50% higher. The losses are also smaller and so is the minus pip value per minute. After a total of 60 trades randomly entered the market at the same time, the difference in losses is 100%. Basically, I recommend that beginners reach the break-even point in the Forex market, as the costs are significantly lower than in the futures market. But you should make some comparisons, as there are countless brokers worldwide vying for the favor of traders. In addition, there are other very important criteria in addition to the spread, such as execution times, commission, pricing, and so on. Each broker has different tariffs, which are often difficult to compare with one another. Here the minimum spread is 1.4 pip, with a commission being due. We dig a little deeper and see that the average spread was 0.13 pips. We now have to add this toth commission and arrive at a spread of 0.58. Trust is good. Control is better, so we record the spread for the entire day ourselves. We can see very quickly that the 0% spread promise can only be kept in 7% of the total time. In most cases the spread is significantly higher, and especially in highly volatile times the spread can rise to over 10 pips. These are extreme values that most other brokers do not offer. We add them up again and arrive at a value of 0.8. Many other brokers also offer this value, although I do not have the risk there in highly volatile times. That is why I recommend that you check the spread yourself. I am providing you with 2 interesting indicators free of charge. First of all, I recommend that you select 35 brokers. You must open a real money account there, because it does not work in the demo because the data is not correct. Deposit 100,200 euros, ideally a dollar account, and then trade with 0.01 lot. At the end of the day, evaluate the spread using my indicators. And then compare the 2 winners in real time. You can find the indicators on my German blog at Forex Factory. In this video I explain from the 6th minute onwards how you get to my blog. Experience is always a series of different skills. The problem, especially for beginners, is that they never know whether a profit was made by chance or expertise. On the other hand, a loss is definitely a mistake, and that is precisely why the learning effect is much higher with losses. Fear, revenge, and greed are the 3 decisive factors that a trader must get under control. But that has nothing to do with mindset, because even a pilot does not fly an airplane with mindset, but solely with experience, and the more experience you have, the more successful you are in trading. Out of 10,000 trades placed, we lose around 6,000, and the secret of success lies simply in the screen time spent and in learning through losses. Let's summarize again. You saw today that you can optimize countless factors in trading with the help of a cheaper spread. Effectively, you can even reach your break-even point in half the time. Of course, many other factors, especially in money management, are crucial to becoming a professional trader in the long term. But as we know, every success begins with the smallest and first step. I wish you all the best and look forward to seeing you here again soon. Best wishes, Michael.